Whenever you search the internet for trading strategies, you are instantly hit with thousands of options. You'll see moving average strategies, indicator strategies, pattern strategies, scalping systems, and day trading systems. Everyone out there seems to be pushing a brand new method that guarantees you'll beat the market. This creates a massive hurdle for beginners. Instead of actually learning how markets function, they end up endlessly jumping from strategy to strategy, desperately hunting for that elusive holy grail. But after spending years trading, analyzing markets, and mentoring thousands of traders, a very simple truth became clear to me. Almost all profitable trading strategies are actually built upon the exact same core idea. They are simply different variations of the same fundamental concepts. Once you grasp this foundational concept, you realize you don't need 20 different strategies, you really just need one. So, in today's video, I am going to walk you through the simplest professional trading framework that most traders will ever require. And the best part, we will turn the strategy into a trading robot for Williams Forex Trader subscribers, so make sure you subscribe to the channel and turn on notification. Before diving in, let's be perfectly honest. This is not a guaranteed way to win 100% every single trade. No strategy or trading robots in the world can promise that. However, it provides a structured method for approaching the market that professional traders have relied on for decades. When you pair this framework with proper risk management, it creates the bedrock of a highly profitable trading process. Part 1. Understanding market structure. Before diving into the strategy itself, we absolutely must understand how markets move. Price doesn't just jump around randomly. Markets generally move in structured patterns. They flow in continuous waves of buying and selling. When buyers overpower sellers, the price moves up. When sellers take control, the price moves down. This dynamic is what creates trends. An uptrend consists of a clear series of higher highs and higher lows. Conversely, a downtrend is made up of a series of lower highs and lower lows. This very simple concept forms the bedrock of almost every single professional trading strategy. Pros aren't just guessing where the price will go next, they are actively observing the behavior of buyers and sellers, aiming to align themselves with whoever is dominating the market. Part 2. The core idea: trend and pullback. Here is the central concept that fuels most successful trading strategies. Trade with the trend and enter during pullbacks. Let's break down exactly how this works. When a market is in an upward trend, buyers are clearly in the driver's seat. But price doesn't just shoot up in a perfectly straight vertical line. It pushes up, it executes a pullback, and then it continues to push higher. These pullbacks are simply temporary pauses within the larger trend. Professional traders deliberately use these exact moments to enter the market. Rather than desperately chasing price after a massive move has already happened, they patiently wait for the price to temporarily retrace. This patience allows them to enter at a far better price and with significantly lower risk. The exact same logic applies during a downtrend. When sellers are dominating, price drops, but occasionally pulls up upward. These upward pullbacks offer the perfect opportunity to enter short and sell the market. So the whole strategy can be boiled down to this: find the trend, wait for the pullback, and enter when momentum resumes. Part 3. Identifying the trend. Step 1 is figuring out the overall direction of the market. While there are countless ways to do this, beginners should stick to something incredibly straightforward. Look at the sequence of the highs and lows. If the price is consistently making higher highs in higher lows, you're looking at a market trending upward. If the price is printing lower lows in lower highs, the market is trending downward. You can definitely bring in simple tools like moving averages to help visually confirm the trend, which is something we'll cover in a future video. But the core takeaway is this: you must align yourself with the market's overarching direction. Trying to trade against strong trends is exceptionally difficult and carries massive risk. Trading in the same direction as the trend allows you to surf the momentum generated by the big market players, the banks and institutions. Part 4. Waiting for the pullback. Once you've accurately identified the trend, your next requirement is pure patience. This is exactly where the vast majority of beginner traders fail. Instead of calmly waiting for the pullbacks, they start chasing the market, trying to desperately jump in on large moves that are already underway. Doing this usually results in entering trades at the absolute worst possible moment. Professional traders do the exact opposite. They wait for the price to retrace back towards zones where buyers or sellers have previously stepped in. You'll often hear these zones referred to as support or resistance levels. During an uptrend, smart traders wait for pullbacks to hit support. During a downtrend, they wait for pullbacks to reach resistance. By doing this, your risk can be managed and controlled much more effectively. Part 5. The entry trigger. Once the pullback has actually happened, traders immediately start looking for visual clues that momentum is returning in the direction of the main trend. This clue could be a powerful bullish candle during an uptrend, a strong bearish candle in a downtrend, or a specific price pattern that clearly signals buyers or sellers are aggressively stepping back in. We call this an entry trigger signal. This trigger acts as your confirmation that the larger trend is likely resuming. The moment that confirmation appears on the chart, the trader can finally execute and enter the trade. Part 6. Risk management and reward to risk. Absolutely every single trade must contain two non-negotiable components, a stop loss and a profit target. Your stop loss acts as a shield, protecting your account capital if the trade ends up failing. Your profit target clearly defines your potential reward. Professional traders specifically look for setups where the potential reward is significantly larger than the risk they are taking. For instance, risking $100 for the chance to make $200. This setup gives you a positive reward-to-risk ratio. Over a large series of trades, this undeniable mathematical advantage is what leads to long-term profitability, even though you know every trade won't be a winner. Part 7. Why this strategy works. The primary reason this strategy is so effective is because it perfectly aligns with natural market behavior. Markets trend because the major players, large institutions and banks, move their massive capital in waves. Pullbacks simply happen because markets require a brief pause to catch their breath before continuing. By choosing to trade the pullbacks within established trends, you are effectively aligning yourself with the heaviest, most dominant market momentum. You aren't trying to possess a crystal ball and predict the future. You are simply reacting to what the market is already showing you. Now, remember this crucial truth. No trading strategy wins 100% of the time. You will always experience losing trades. Even top-tier strategies can hit a losing streak. What truly matters is that your strategy possesses a statistical edge over the long haul, and that edge will only protect you if your risk is managed strictly. A strategy on its own is never enough to succeed. Flawless risk management is the secret ingredient that turns strategies into profitable systems. We have built a trading robot for this strategy. It uses pending orders to trade the levels. Make sure you subscribe and join our Telegram channel to gain access to the robot. It is 100% free. Next steps to learn trading properly. If you are ready to start practicing this approach or using the trading robot, your very first step is to avoid using real money. Open up a demo account immediately. Spend time studying price charts, practice spotting those trends and pullbacks, and meticulously document your trades in a journal, or if you are trading with the robot, see how it performs. Over time, you will naturally begin to recognize the patterns and build real, practical experience. Genuine trading skill is forged through endless repetition and careful observation. absolutely never through shortcuts. So, yes, there are thousands of trading strategies floating around the world, but the vast majority are built on this exact core idea: identify the trend, wait for the pullback, and enter when momentum resumes. This beautifully simple framework is exactly what professional traders have utilized for decades. When you pair it with ironclad discipline and strict risk management, it acts as the ultimate foundation for a robust professional trading career. True success in trading doesn't come from endlessly chasing shiny new strategies. It comes from mastering a simple, proven process and executing it with absolute consistency over time. I know this was a high-level overview of how a trading strategy functions. If you're looking to dive into the objective, step-by-step rules of a specific strategy, make sure to check out this video on the screen right now. Or, if you're ready to take your learning to the next level, drop a comment "challenge" and we will start 30 Days Trading Challenge together. Don't forget to like and subscribe to this video for more.